Good morning, ladies and gentlemen, and welcome to the show on this Monday, the 2nd of August, 2021. Thank you for tuning in. You know what? Right under our noses, the Fed is creating a new switching mechanism. They used to, they're one of their biggest mechanisms they used through history to control things. The Fed was they'd raise interest rates or lower interest rates. They want to speed up the economy a little bit. They'd make the price of borrowing money cheaper, so they would lower interest rates, and that would speed everything up. And there's a very powerful mechanism. They wanted to slow everything, cool everything down. They'd raise interest rates, and that would make the price of money much more expensive. Now they can't use that mechanism anymore. They can't raise interest rates because the debt is too high now at this point. To raise interest rates, they won't be able to service the debt. They can't even raise them a little bit. So they've lost that mechanism. Guess what? Right under our noses, they've created a new mechanism. It's these standing repo operations. The standing facility, they can work with trillions of dollars in the system. It's going on right now. The reverse repo operation, which is what they're performing right now, draws liquidity out of the system, and the opposite of that, which is a regular repo operation, injects liquidity into the system, and this has become a new mechanism that they're using, and they've built it right under our nose, and it's moving trillions of dollars. Now let's open up the charts right here and take a look at this. Okay, it says the repo facility has a large octopus handing money out and taking money in daily. Financial institutions use this facility to fund their day-to-day operations. The Feds also use the facility to inject more cash into the system when the economy slows, or take money out of the economy when it overheats. This sort of two-way street that helps the financial institutions control their cash flow while helping the Fed gas the economy, stimulate it, or even put the brakes on to slow the economy down. Now, I'm going to tell you, it's projected over the next few months, moving in toward the latter part of this year, that the Fed's reverse repo operation is going to go all the way up to $2.5 trillion from where it is right now. It just touched a trillion, the first trillion. Okay, so right now they're using this to effectively try to slow down inflation. So it's a new mechanism that they got to slow down inflation by withdrawing all this money out of the banking system. But what it's an indicator of is that the system is actually broken. Because the normal way the banking system works, they're the biggest creators of money out there. And they use that liquidity on hand on a basis of what's called fractional reserve banking. So they keep a tenth of the liquidity on hand, and what they do is they make loans out. This is the way they've done all the way through. What we have here is complete financial engineering. And I can see the intention here is to keep this game running as long as they possibly can. But what we've seen since 1914 till now is a slow disintegration of the purchasing power of the dollar. We've seen over 97% of the dollar's purchasing power eliminated. And so that's not going to stop. And so this financial engineering that they got going right now is trying to keep this Ponzi scheme system that they've got running perpetually through financial engineering. In other words, they're trying to squiggle their way out of something that you can't squiggle out of. But what they can do is through this financial engineering, they can delay the inevitable outcome a little bit longer. It's called kicking the can down the road. And this is a powerful tool that they have to help delay this inevitable. Prices aren't going to come back down again. You know, I mean, if you paid $1 for a can of beans there a year or two ago, and now that can of beans has went up to $1.59. Prices aren't going to come back down again, but what they could do is stop the rising effect of prices where we've seen more than 10% inflation. Consumer price index is higher than 10%. What they could do is, using this repo, this new method that they've got now, they could bring it down so that it's in a more stable range. Maybe they could bring the inflation rate down to 4% or something, you know, using this, because as they draw this liquidity out, but it's going to be a very temporary effect, because what's going to happen is later this year, when they get up toward $2.5 trillion, they're going to see tremendous volatility to the downside in the markets. So they can only use this so far. It is a new tool that they have, this reverse repo and repo operation, and they've said standing facility now. Anyway, let's move on and take a look at the price of silver today. It's in such a tight, narrow band of range that what they've done is they've moved the chart in right close, like we're looking at it real closely here. And that's why it looks like the chart looks like it has more volatility than what it has, is because we're in a close-up, because it's in a very tight, narrow range in around 25.43. It's right in the center of that range right now. So the price of silver is 25.43. It's down 3 cents on the day. Let's take a look at gold. Gold is in a narrow trading range too, not quite as narrow as silver, but gold is running at 18.13 today, and it's down 50 cents. So you might as well say they've basically they're not moving up or down. They've consolidated into a very tight, narrow range. Now you know what that means, guys, don't you? It means that gold and silver are getting ready for a breakout. They consolidated right down into a very tight, narrow range. That means they're getting ready to break to the downside or to the upside. One of the two. Doesn't mean it's going to go down. Doesn't mean it's going to go up. It just means that they're getting ready for a breakout in one of those two directions, either up or down. And, you know, it's up to you guys to figure it out which way they're going to go. Cryptocurrency today is 1,615 billions, and we're looking at a Bitcoin price of $39,654. Bitcoin is just went through a little bit of an up in price. It went through a consolidation there. So Bitcoin does it so much faster. And it consolidated in around 30,000. Now it's went up to 39. You know, 39,625 today. But Bitcoin could be consolidating again now in around the $40,000 range. Getting ready to make a move up or down. Cryptocurrency today, and now we're going to take a look at the Dow Jones Industrial Average, which is up 180 points on the day at 35,115. Yeah, that repo, if it goes to $2.5 trillion, it's gonna really start to dig deep into any amount of excess liquidity that's in the system, and we all know that all the stimulus is just about its effect, its wealth effect. It came from the stimulus measures have pretty much worn off now, and so what I see them doing is setting things up for a crash. And in the not too distant future, I don't think they can go to $2.5 trillion being held by the Fed. All that liquidity being held by the Fed. The bank's not making any loans. In fact, the bank's withdrawing lines of credit. And at the same time, all the stimulus measures basically are done, you know. People have spent all that money now. And what we're looking at is an economy where we have all these people out there who are getting this moratoriums on the rent, is coming due now. They're getting eviction notices sent, out in mass. I don't see where this is going anyplace else but a sudden volatility of a crash, like a crash into the markets, and they're not going to let it go. I don't think really they're going to let it go more than 10% now at this point. I know I was thinking 20%, but I'm starting to think to myself, hey, they're going to do exactly what China's just did. China had a market crash and everything. Market fell out of bed, and now China's promising more stimulus. And now their market's going back up, and they're going to do the same darn thing here. So we could have a drop, 5 to 10% in the markets, and then they'll come in and they'll loosen policy again. We're right in the middle of modern monetary theory gone amok, and them being able to control the spigot of money. And so it creates volatility, but ultimately they're not going to let anything fall in the end. And so what we're going to be seeing is inflation is going to just keep marching on and marching on until your dollars are dead. So if you're sitting there and you're in dollars, they ain't going to let this thing go down. Your dollars are not going to become worth suddenly more. It's going to be quite the opposite. The ultimate conclusion in all of this. What you need to do is you need to have assets that are out of the dollar that have no counterparty risk. And the best of these assets is real physical gold and silver. It's the best way to fight what's going on with this modern monetary theory that's happening right now. Let's take a look at crude oil. It's 73.07. It's down 1.19% on the day so far. Move index 61.19, and so the move index has cooled off a little bit. It was up to 70. Now it's at 61.19, so the pressure's off a little bit on the move index. Let's take a look at bonds and rates, and we do see falling yields today. We're looking at quite substantial falling yields. Looks like 5.2% on the U.S. 10-year at 1.18, and the U.S. 30-year is at 1.86, and it's fell some too. Yeah, right now there's a bind for treasuries and stuff because they're using the Treasury General account to fund the government, and they're not creating new treasuries because they're funding the government with the Treasury General account. There's a big thing going on with the debt limit too, the debt ceiling. They're going to start running out of money, and it's not absolute certainty with the debt ceiling every time. I know every time they come in at the last minute, they sign a bunch of papers and stuff, and they push the debt ceiling up higher, and everything. But, I think they're going to let it run to the last minute this time, and there's such a, I don't know how to describe it, but there's no support for where the parties can actually come together anymore. They don't come together. They don't see eye to eye on anything anymore. And letting this thing run to the last minute is a very dangerous option, because if they go past that line in the sand and they run out, the Treasury General account doesn't have any more money, and they've exhausted all the other options that they have, little money pools that they have set aside for a rainy day, and all of a sudden they start to run out. Janet Yellen's already warned. She's already said that this could be a tragic situation if they hit that spot, if they let it hit that spot and cross that line in the sand. What it could do to the world's financial system would be unimaginable. Basically, and so they're playing with fire. And I know it's never happened before, and they've always done it. Nobody's paying any attention to it right now because it's one of those things where they always repair it at the last minute. But do you realize what would happen if they step over that line? By accident, maybe. Okay, let's end the show on that note. That I'm going to tell you guys what. We are living in one heck of a weird system right now. Everything is topsy-turvy, upside down. And I don't know what the outcome from all this is going to actually be in the end, but it's going to be inflationary. We're going to see our dollars become worth less and less. And in the end, could we go into some sort of a massive hyperinflation suddenly at a certain point that goes out of control? Or could it spin out of control into some sort of a deflationary scenario where everything just basically freezes? Because what's happening is more and more pressures coming on this financial system. The more they uh, use extraordinary measures to run the financial system of things like what they're doing with this reverse repo operation. It's more and more financial leverage is what I'm trying to say, and that creates more and more pressure. As they borrow more and more debt into existence, it creates more and more pressure on the system to flop one way or the other. Anyway, thank you guys for listening. Like and subscribe, and we'll catch you guys in the next show. Bye-bye.